Welcome to this deep dive on building a retirement from almost nothing starting at age 50. First, I will set the context. If you have limited retirement savings and just 2 decades until age 70, a conservative approach likely will not get you there. Therefore, we will focus on the controversial but often necessary approach for late starters: extremely aggressive saving and investing, paired with strict risk controls. Next, I will lay out an agenda so you know exactly where we are headed, and then we will move through an actionable plan you can begin today. Finally, please remember this is educational content and not individualized financial advice. Here is our roadmap. First, we will define the late starter problem and why the next 20 years matter more than anything else. Then, we will quantify urgency with simple, illustrative math. After that, we will outline an aggressive allocation strategy focused on equities and explain why bonds may be a drag when starting near zero. Next, we will cover tax-advantaged account priorities, including Roth IRA and solo 401k options. We will follow with a 90-day action plan and then discuss risk management to survive volatility. Finally, we will test your knowledge with 2 quick quizzes and wrap up with key takeaways. Before we proceed, please note, this content is educational and not individualized financial advice, tax advice, or legal advice. Your situation is unique, and regulations and contribution limits change. Therefore, consult a fiduciary financial planner and a tax professional to tailor any strategy to your circumstances. Additionally, aggressive investing involves significant risk, including loss of principal. We will discuss risk management, but nothing eliminates risk entirely. Now let us frame the challenge. Starting at 50, you have roughly 20 years until age 70. The earlier years are the most valuable because contributions compound longer. Meanwhile, losing time means you must lean on higher expected return assets to catch up. This timeline highlights phases: aggressive accumulation early, then minor, de-risking only if targets are on track, and finally building a cash buffer ahead of retirement. The key message is that each year counts more than the last, so urgency must be the theme. Let us quantify the urgency with a simplified example. Suppose you start at age 50 with either $5,000 or $14,000 and contribute $800 per month for 20 years. Using an illustrative 8% annual return, the difference in ending values by age 70 can exceed $40,000. This is because a larger starting base compounds for longer, creating a noticeable gap even with the same ongoing contributions. Therefore, once a small emergency fund is set aside, every additional dollar should be redirected toward investment, because the earlier it goes in, the longer it compounds. Here is an actionable 90-day plan. First, ensure you have a 3 to 6 month emergency fund so you can stay invested during downturns. Next, open or confirm access to accounts including Roth IRA, workplace plans such as a 401k or 403b, and a health savings account if eligible. If you have self-employment income, explore a solo 401k. Then, automate contributions directly from your paycheck, targeting at least 20 to 30% of gross income, if at all possible. After that, select a simple, low-cost fund lineup: total U.S. market plus international. Meanwhile, aggressively cut expenses and redirect those savings to investments. And finally, consider developing side income and funnel all of it into your accounts. This flowchart illustrates a practical funding order. First, confirm the emergency fund. If it is not in place, build 3 to 6 months of expenses. If it is in place, check for extremely high interest debt, above 20% annual percentage rate. If that exists, pay it off first, because it is risk-free negative return. If not, proceed to capture the full employer match in your 401k. Next, maximize contributions to a health savings account if eligible, which can provide triple tax advantage. Then, maximize contributions to a Roth IRA, subject to eligibility rules and potential backdoor strategies if applicable. After that, increase contributions to your 401k or 403b toward the annual limit. If you have self-employment income, utilize a solo 401k to shelter even more. Finally, use a taxable brokerage for additional investing. Throughout, automate contributions and rebalance annually. Because the portfolio starts small and the runway is short, the expected return must carry more of the load. Therefore, many experts recommend staying at 90 to 100% equities until retirement is close. The key is diversification, Pair a total U.S. market index fund with meaningful international exposure of at least 20 to 30% to reduce single market risk. Choose ultra-low-cost index funds to avoid fee drag. In contrast, a heavy bond allocation at this stage can materially reduce growth potential. As you approach retirement, and only if you are on pace, you can initiate a small glide path, slowly adding stability. Let us compare two paths. The conventional approach increases bonds with age to prioritize stability. This approach works well for investors who started decades earlier and already accumulated significant assets. Meanwhile, the late starter reality is different. With a small base and limited time, bonds can be a meaningful growth drag, making it harder to reach a sufficient nest egg. Therefore, a late starter approach emphasizes equities for higher expected return, coupled with strict savings discipline and risk controls. A glide path is considered only when targets are being met and retirement is approaching. These scenarios are purely illustrative and assume a simplified 8% annual average return over 20 years, which is not guaranteed. The first row shows a $5,000 starting balance with $800 per month in contributions. The approximate ending value is around $462,600. The second row increases the starting balance to $14,000 while keeping contributions the same. The ending value rises to roughly $504,600. The third row holds the $14,000 start, but increases savings to $1,200 per month. The ending value climbs to approximately $724,200. The purpose is to demonstrate how both starting capital and contribution rate materially affect outcomes. Next, let us turn to taxes. Tax-advantaged accounts can materially increase your after-tax outcome. A Roth IRA allows for after-tax contributions, with tax-free growth and withdrawals if rules are met. Traditional workplace plans like a 401k or 403b offer pre-tax or Roth options. Capturing the employer match is essential. Health savings accounts, if you are eligible, can provide triple tax advantages. Finally, for those with self-employment income, a solo 401k can dramatically increase contribution limits. Confirm eligibility and check current IRS limits each year. Here is your account playbook. First, maximize the Roth IRA if eligible, benefiting from tax-free growth. If your income is above the Roth limits, consult a professional about backdoor Roth strategies. Next, in a workplace plan such as a 401k or 403b, secure the employer match, and then work toward the full annual contribution limit if possible. If you have access to a health savings account, consider investing those funds while paying medical expenses from cash, preserving the HSA for long-term compounding. If you earn self-employment income, a solo 401k can dramatically increase how much you can shelter. Finally, after maximizing tax-advantaged accounts, continue investing via a taxable brokerage account with low-cost, broad market index funds. This Gantt chart outlines a repeatable year. In the first quarter, make Roth IRA contributions by the tax deadline and ensure workplace plan contributions are on track. Through the middle of the year, focus on building side income and scheduling an allocation review to confirm your aggressive stance still matches your goals and capacity for risk. In the final quarter, evaluate tax loss harvesting or other tax optimizations where appropriate, and then schedule a year-end rebalance. Repeating this cadence helps maintain discipline. Question: for a late starter at age 50 with minimal savings, which allocation is most consistent with the aggressive catch-up strategy discussed? Options: A. 40% equities and 60% bonds. B. 60% equities and 40% bonds. C. 90 to 100% equities with broad diversification. D. 100% bonds until age 65. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. When starting near zero with a short runway, expected return must carry more weight, and broad equity exposure is generally the most effective way to increase expected returns. This usually means total U.S. market plus at least 20 to 30% international. Remember, however, that this approach comes with higher volatility, so risk controls and discipline are essential. Question: which funding order best captures both tax efficiency and practicality for most late starters? Options: A. Taxable brokerage first, then HSA, then 401k match. B. Pay off debt above 20% APR, then employer match, then HSA if eligible, then Roth IRA, then 401k or 403b to the limit, then solo 401k if applicable, then taxable. C. Roth IRA only. D. Skip HSA, because it is for healthcare only. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Paying off very high interest debt is essentially a guaranteed return. After that, capturing the employer match is an immediate, risk-free benefit. Next, maximize HSA if eligible, then Roth IRA for tax-free growth, followed by increasing contributions to 401k or 403b toward the limit. If you have self-employment income, deploy a solo 401k to further increase sheltering. Finally, invest in a taxable account once the tax-advantaged options are exhausted. Aggressive portfolios must be paired with risk management. Maintain a 3 to 6 month emergency fund to avoid selling during market stress. Automate contributions and rebalancing to reduce behavior-driven mistakes. As you approach retirement, consider building a small cash bucket of 2 to 3 years of essential expenses to provide a buffer against sequence of returns risk. Income flexibility, such as part-time work, can further reduce the need to sell during downturns. Initiate a glide path only if your projections indicate that you are on target. Here are the key points. First, with only 20 years, both contributions and higher expected return must work together. Second, broad diversification via total U.S. market, plus meaningful international exposure and very low costs, is essential. Third, maximize tax-advantaged accounts, such as Roth IRA, 401k or 403b, HSA if eligible, and solo 401k for self-employed income. Fourth, maintain an emergency fund, automate contributions and rebalancing, and stay consistent. Finally, consider de-risking only when your targets suggest you are safely on track. To summarize, an aggressive approach may be necessary for late starters, but it must be paired with strict discipline and risk management. Maximize tax-advantaged accounts, automate contributions, and use broad, low-cost equity funds with international exposure. Reassess annually, and consider gliding down only when your targets indicate safety. Finally, remember that side income and expense management act as force multipliers for your plan. Thank you for watching. If this was helpful, please like the video, share it with someone who needs a late start plan, and subscribe for more practical investing content. In the comments, share your first 3 action steps and your target contribution rate so we can learn from each other and stay accountable.